Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that is technically an amendment, but it basically hides a pretty interesting, and dare I say, bold new financial maneuver. Think of it as a company trying to get a second chance to sign its homework, but the homework itself reveals a new strategy. We're talking about Fold Holdings Incorporated. So, this is an amendment to a report called an 8K. Think of an 8K as the company's way of telling the public about really big, important stuff happening right away. This amendment is mainly to fix a small oversight, like forgetting to sign a document, but the original filing from the 1st of October 2025 is where the real meat is. Fold Holdings Incorporated is the company we're looking at. They operate a few interesting things, including common stock traded on the Nasdaq capital market under the ticker symbol FLD, and warrants under the symbol FLDDW. This filing talks about a new credit facility, which is essentially a fancy way of saying a loan agreement. The big news here is a master loan agreement, or MLA for short, that Fold Holdings subsidiary Fold Incorporated entered into. They're reborrowing money from a company called 2 Prime Lending Limited. This isn't just a small loan, it is a revolving credit facility, meaning they can borrow, repay, and borrow again, up to a total of $45 million. Now, let's talk about the money. The interest rate is 6.5% per year. That is not too bad in the grand scheme of things. The first loan they take out under this agreement is due in October of 2026. They can pay back the loan early without any penalties, which is a good sign showing flexibility. But here is where it gets interesting with the late fees. If they miss a payment, there is an extra 5% a year late fee. That can add up pretty quickly. So what are they doing with all this borrowed money? Fold Holdings says it is for working capital and general corporate purposes. Basically, they're going to use it to keep the lights on and fund their day-to-day operations and growth. And they explicitly mention this facility provides non-dilutive capital. That is a key phrase. Non-dilutive means they are not selling more stock to raise this money. This is important because when companies sell more stock, the ownership percentage of existing shareholders gets smaller or diluted. So, they're getting cash without giving away more ownership. They also highlight that it helps them manage their Bitcoin treasury. This tells us they likely hold Bitcoin as an asset and will use this loan to support that strategy without having to sell their Bitcoin. Here is the crucial part, and it is what makes this loan arrangement unique. To get this $45 million loan, Fold Holdings has to put up some of its Bitcoin as collateral. Think of collateral as a safety net for the lender. If Fold Holdings can pay back the loan, the lender, 2 Prime, can take the collateral. They've set up a special agreement with a custodian called BitGo Trust Company, Incorporated. All the collateral Bitcoin will be held by BitGo, and 2 Prime has a say in it, but can actually use or lend the Bitcoin. This is where things get really technical and potentially risky. The loan requires a high level of collateral. For the initial loan, they need collateral worth 250% of the loan amount. That means for every dollar they borrow, they need to pledge $2.5 worth of Bitcoin. This is to protect the lender from price drops in Bitcoin. If the value of the collateral drops too much, they get a margin call, meaning they have to add more Bitcoin to the account. There is a specific point called the liquidation level at 175%. If the collateral value falls below that, the lender can automatically sell the Bitcoin to get their money back. This is a big deal. If Bitcoin prices fall fast, they could lose their collateral very quickly. Also, if Bitcoin drops 25% or more in a 12-hour period, the lender can demand immediate repayment of the loan, which could be a problem if they don't have the cash readily available. The list of things that could trigger a default on this loan is pretty standard for these types of agreements. It includes not paying back the loan, not paying fees, issues with the collateral falling below the required levels, or if the company faces bankruptcy. If a default happens, the lender can take the collateral, sell it to recover their money, and the company basically has no control over how or when that sale happens. Beyond all that, the agreement includes the usual stuff you'd expect: promises that the company is operating legitimately, rules about how they'll handle information, and how any disagreements will be sorted out. The actual agreement itself and its schedules are filed as exhibits, and you can look at those if you want all the nitty-gritty details, though they've omitted some of the very detailed schedules. This section just confirms that this loan agreement creates a direct financial obligation for the company. Pretty straightforward. This points to the actual master loan agreement as Exhibit 10.1. It is important to note that certain parts have been redacted, meaning blacked out, for confidentiality reasons, and they've omitted some schedules. But the publicly available version gives us a good understanding of the deal. And finally, we see the signature block will Reeves the chief executive officer, signed off on this on the 1st of October 2025, confirming the company's commitment to this agreement. Now, looking at this arrangement, Fold Holdings is making an interesting bet. On one hand, securing a $45 million credit line without diluting shareholders is a smart move. It gives them flexibility and capital to operate and potentially expand their Bitcoin holdings. However, the reliance on Bitcoin as collateral is a significant risk. Cryptocurrencies are known for their volatility. If Bitcoin prices experience a sharp downturn, Fold Holdings could face margin calls and even forced liquidation of their assets, which could be devastating. This strategy is essentially a high-stakes play on Bitcoin's price stability or upward trajectory. They re-leveraging their existing Bitcoin to get more capital, but they re-putting that same Bitcoin on the line. The high initial collateralization level of 250% offers some cushion, but the rapid liquidation triggers mean they need to be incredibly vigilant about market movements. In conclusion, Fold Holdings is undertaking a potentially powerful but risky strategy by utilizing a Bitcoin-backed loan facility. The ability to raise capital without dilution is a major positive, but the inherent volatility of Bitcoin as collateral presents a substantial risk. Their direction seems to be growth funded by debt secured by their digital assets, which indicates a higher risk tolerance. Investors should watch the price of Bitcoin and the company's ability to manage its collateral closely. Alright, that is our breakdown of Fold Holdings' latest filing. What is your take on this Bitcoin-backed loan? Do you think it is a smart move or too risky? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.